So now it's time for some exercises to clarify this. So first we have the simplest of the OID accounting, and that's the OID for a zero coupon bond. So imagine that on January 1st, 2015, Lemonade Stand Enterprises issues a 5-year zero coupon bond with a $10,000 face value at $7,835. So just to be clear, what Lemonade Stand Enterprises gets in cash from this borrowing is $7,835 on day one, and now they have an obligation to pay $10,000 5 years from now. There are no coupons or interest payments during the 5 years. Basically, the discount is $2,000 and change, and that is the implicit interest that has to be paid. There's no annual interest payments. From a FASB standpoint, from a US GAAP or IFRS standpoint, that doesn't matter. Accrual accounting requires that we represent the implicit costs annually over the term of the loan, and we're going to do that via amortization expense, which we lump within interest income on the income statement, which also slowly increases the carrying value of the loan all the way to the end of the period when the loan balance will be $10,000. So give this a shot. Hit the pause button and try it on your own. Using an Excel file will be easier to do this because there's a lot of sort of calculations. And what I will say is, so first assume a 40% tax rate. Assume the loan matures on January 1st, 2020. So, by the final year here, the loan balance will be $10,000 and the next day it'll be fully repaid. So we don't have to worry about the journal entries for repaying the loan. We want it right up to the day prior to the loan maturity. And then the one final thing is the key to being able to calculate amortization expense, which is going to be lumped into interest expense here, is to determine the implied discount rate required here. So what is the implied discount rate for a zero coupon bond that's issued at $7,835, which will mature at $10,000 5 years from now? That's the key to understanding this exercise. Hit the pause button, give it a shot, and then we'll go through it together when you're ready. So let's go through this exercise. The very first thing that we need to do before we can complete the income statement and understand what's going on in interest expense as well as the loan balance is first understand what is the implied discount rate for the series of inflows and outflows. And understand that for a 5-year zero coupon bond with a $10,000 face value issued at $7,835, the inflow to the company on day one is $7,835, and the only outflow comes at the end of year 5, and that's a $10,000 outflow. So what we see is that actually lends itself to just a simple IRR calculation in Excel. And so if we input the following IRR calculation, these are the 5 cash flows. It's just a series of inflows and outflows, and that gets us to an IRR of slightly above 5%. We can round down to just 5%. Now, with that in hand, this becomes a more straightforward exercise. We're basically saying that just conceptually what this represents is that if you issue something at $7,835 and 5 years later you have to pay $10,000, the internal rate of return on that is 5%. The lender is basically getting an implied interest rate of 5%. They're just not getting it currently. They're getting it at the very end, but on an annualized basis, they're looking at 5%. So at 5%, what kind of interest expense would that yield? And the way to calculate that is simply to go into interest expense and say, okay, I'm going to take that 5%, which is my implied interest rate, really, times the original loan balance. That gets you the interest expense that needs to be recognized during that period, that $392 million. And of course, that's non-cash interest. It's amortization of the original issue discount. But from an accrual standpoint, that represents the current period expense associated with the benefits of that borrowing. And so under both US GAAP and IFRS, that amortization is going to get recognized, reducing pre-tax income, reducing your tax obligation, bringing you down to the following net income. The corresponding entry, so this interest expense calculation here, understand that is a reduction to retained earnings. So that is a debit to retained earnings. The corresponding credit is to the loan balance itself, which starts at 7.8, let's use denominations of millions here, $7.8 million. And by the end of the period, it has increased by the amortization of the loan balance. In other words, now the liability, now that we're a year closer, is now closer to that ultimate liability of 10,000 by 392 million. And so the corresponding entry is the amortization, which increases the value of that liability. So in fact, let's actually focus on this guy right here. So these are the two corresponding debits and credits. And now the next year, the interest expense, or the amortization that's buried within interest expense, is a function of that same 5% implied interest rate by the new loan balance. Now you have a loan balance of $8.2 million. The interest rate is 411,000. And so now that increases the loan balance. And every year this is happening. The calculation is off of the new carrying value until it just exactly equals, by the end of the final year before the term is over, the loan balance is exactly what the liability is going to be the next day. And that should make sense, because if at the end of this period the loan balance is 10,000, well, the next day, January 1st, 2020, that's the liability that you actually have. And so this accrual accounting is about getting you every year to reflect the accrual-based liability that exists, so that by the end of the period, you're actually representing the liability that you really have.